Hey guys, welcome back to the channel. This is Sense or Sense, and my name is Evan. And today I want to come to you and talk to you a little bit about how I made my first million over the last 35 plus years. I thought it would be an interesting discussion to talk about how I specifically went down this path. Believe me, it was not easy. It took me quite a long time. It required a lot of sacrifice, and it started off at a very early age, and delayed gratification is all about how it works. So I wanted to come to you and talk to you a bit about the different things that made the most impact on making that first $1 million. And the first and foremost is, instead of working for someone else, I started to work for myself at a very young age. And I started learning from my dad and my grandfather and some other people about the stock market, investing, how to be self-reliant, how to make your money work for you instead of handing the money off to someone else and hoping that they could make your money work, as well as trying to work for someone else and hopefully getting a paycheck. And I learned from a very early age that I needed to do it on my own. And so this is one of the things I learned. And at about age 13, I started going to my neighbors and I started talking to them about, hey, can I please mow your grass? Can I do any errands around your house? Can I do anything? Can I be a little handyman that can go get anything for you? And of course, that didn't really make me a lot of money, but over time, I built a reputation in the neighborhood as being reliable, and it eventually turned into something where my neighbors would ask me to do some things for them, and as I got my car and a little bit older, around age 16, I could actually go and pick up things for them. I started a computer repair business based on the same people that were trustworthy enough to do the other things. And so that kind of launched me into being an entrepreneur. So I would say that was kind of the first combination of learning early about money and then applying that to a small business and not working for the man, so to speak, the corporation. I would say the next thing is leverage corporate America, but don't necessarily work for it. And what I mean by that is utilize all your friends, neighbors, colleagues, people that you know that are working for corporate America to possibly get you other contacts for your own small business, and or maybe you strike a deal with a corporation with your small business to do something for them. And I had numerous opportunities in my life to be able to do this. I actually had an organization in the Austin area allow me to start working on their computers to repair them when I was only about 17, 18 years old. So I didn't even have a high school education completed, never less a college education. But I knew someone at the organization. They had me personally work on several of their own computers, and it landed me a job. And I was making at a very young age a very good amount of money, and it was something I loved to do. I didn't have to I was working for myself essentially, and it taught me to be self-reliant, and it kind of sparked my desire to be a self-employed individual the rest of my life. And so that leads me into another topic, which is you need to invest early, often, and sacrifice things early in life to be able to allow for compounding to work. So this is really critical. It requires all of them. You've got to be early, you've got to do it often, and you've got to be able to be diligent about it and not make excuses. And then the money can actually compound over long periods of time. I'm not going to get into the rule of 7 and things like that. You can Google that or look at other YouTube channels about that. But ultimately what it boils down to is very simple. The earlier you start, the more your money can work for you and not against you. And so because I had started my businesses very young in life, I was able to start saving just a couple $1,000s a year. I think my first year I might have put away like $1,500, and then it turned into like $3,000 the next year, and then $5,000, and then $10,000, and so forth. And there were some lean years in there. I've been in finance for a long time, and that the stock market and the financial field had a lot of problems in the early 2000s, as well as 2008 through 2010. It was not fun, and it was not easy. This was a 30 plus year process that I've been through here. I'm 46 years old. I started my first business when I was roughly 13, and I've owned over a dozen businesses since then. And all of these businesses have been somewhat successful at times and not so successful at other times. I didn't have one that was just like immediately successful and made me a bunch of money. And so that kind of, leads me to my next point, which is don't be afraid to fail. I've had over a dozen businesses. I lost track after that. Some of them were very short-lived, probably closer to 20 businesses realistically, but over a dozen reasonably longer-term businesses. And I would say that I was only really successful at 3 or 4 of those businesses. The rest of them either failed right away, failed very quickly, or I shut them down because they just weren't profitable enough, or I was having problems with someone or something or a combination. Business partners can sometimes be a really good asset, but most of the time I found not so much. I've actually had several business partners really pull the rug out from underneath me and cost me potentially $1 million or more over the years. So that's kind of a little sidebar note, maybe a whole other video actually. But you've got to be willing to fail. 80% of all small businesses fail in the first 5 years. I'm sure you've heard that statistic before. I'll raise my hand. I'm definitely a part of that crowd. I've definitely had about 80% failure rate and probably about between a 10 and 20% success rate. So you have to be willing to go down that path. The other thing is always live below your means. Sorry, I couldn't read that there for a second. My handwriting wasn't that great. Always live below your means. It's pretty simple to say that, but to do it is another thing. And I'm not talking about for 6 months. I'm not talking about a year. I'm talking about this is a lifelong thing that you must do. You've got to live well below what you make. There might be a year where you have an accident or you have to pay out for a large amount of medical bills or something like that. And yes, that's going to occur. So you're not going to necessarily every single year of your life live below your means. I'm not saying that at all. I'm just saying as a general rule of thumb, you need to live below your means for 90+% of your life. And there are lots of ways to do that. One of the things I've always used to do when I was younger was I was a big couponer. Believe it or not, coupons do save you a lot of money. I was able to get a lot of buy one, get one free sandwiches at Subway, be able to take that sandwich home, eat it for dinner. When I bought the 2 sandwiches at lunch, that saved me a lot of money. I had several stores around me, grocery stores around me that would do double and triple coupons up to 35 and 50 cents. And when you're struggling to make ends meet and you can take 5 35-cent coupons and they turn into $1.05 instead of 35-cent coupons, and you can buy some spaghetti for you and your wife or you and your family, that adds up quickly. So don't ever knock the freebies or the discounted items, the sale items. I usually combined a lot of sale items with coupons, and I got a lot of stuff. I was getting $200-300 worth of product in some cases for $40-50. So this is the way that you can live below your means. The longer time you can live below your means, the more your money can compound, and you're not going to spend it, and you're going to be able to let it work for you instead of against you. So leverage ways to take advantage of corporations via credit cards. So I say this, and this is kind of a way of saying, go out there and find the ways that you can take advantage legally, not illegally, legally of companies and company benefits. Go out there to Bank of America, Chase, Capital One, get credit cards when you have a good credit score. Build that credit score. Make sure you keep your credit score high. That's another corollary. Make sure you keep your credit score high. Credit scores affect everything, including your insurance rates and everything. So go out there when you do have a good credit score and start applying for cards regularly. Get the bonus sign-ups. Get the extra points when you go and spend on things that you need to. This is not a way for you to go out and spend money you don't have. It is a way to take advantage of getting additional benefits from the money you're going to spend already. So if you can go get yourself a 2% cashback card, and if that's the only card that you have, and you run all of your spend through that 2% card. Last year I spent about between $90,000 and $100,000. So you can do the math. That's $1,800 to $2,000. Although I was able to leverage it with mini cards and probably get more like 4 to 5%, if you include the benefits of points and whatnot. So I'm getting $4,000 or $5,000 back roughly. That's not an insignificant amount of money relative to the amount of money you're spending. And it starts to add up quickly. If you can put that money towards something else from the cashback side, or you can use it to travel for free like I do. I'm taking my wife on a trip to Paris for our 10th anniversary, business class, Air France, and 6 nights in a super nice Hyatt suite, and all of it's covered by points that I got from credit cards. So what do you value that trip at? I don't know what it's worth retail-wise. I would think it's worth at least $25,000. Just because the airline tickets alone are $7,000 or $8,000, and the suite is $800-900 a night in central Paris. So it is worth a lot of money to me to get cash back, to get points and cash back, and utilize that to leverage additional spending and additional benefits. So please take advantage of those opportunities. Don't be afraid to go out and get a credit card if you haven't gotten one. You got to build that credit score some way. That's the number one way of doing it, in my opinion. And then just make sure you're never going to carry a balance unless it's an absolute emergency, and make sure you pay it all the time, every single month on time. That's critical to this strategy. So finally, I would like to learn, at the end of all of these above things that I've told you, there is one thing that I've learned, and that is the more you can turn your earned income into passive income, the less you're going to pay to the tax man, and the more you're going to keep, and the more it's going to be able to compound, and it's going to be a very good thing for your long-term future monetary goals. So what I mean by this is, have rental real estate when it comes time to do that. Have lots of stocks and investments that are passive, that you're not actively going out and trying to earn on your own. These types of investments shed lots of money in the long term. They cost you a lot up front, and they're difficult to get to begin with, but once you have them, they start earning you passive income. Passive income is generally not subject to Social Security, and it's not subject to income tax depending on the circumstances. But with regards to investments in particular, stocks, bonds, mutual funds, things like that, for the most part, it is considered to be a much lower taxable event. It is not earned income in most cases, and therefore you're getting payouts that are capital gains, either short term or long term, and that's a subject for a different video. But those are taxed without Social Security, and they're taxed at a lower rate. So the more that you can have that are passive, the more that you can turn your investments and your income into streams that are not being siphoned off to other sources like the tax man. So those are kind of the big sources and the big ways that I was able to earn $1 million. And let me tell you, this is kind of a bonus content right now. The first million is way harder than the second. So the first million took a good majority of my 30s into my early 40s. The second one was very quick. Of course, the markets have been great recently, but that isn't all what caused that second million to kind of snowball. It was the compounding factor, the passive income, the understanding of all these other things that we've talked about today that created that wealth very quickly. So I appreciate you guys tuning in. I thank you. Hit the subscribe and the like button if you found any interest in this whatsoever. I appreciate you guys tuning in to Sense or Sense. My name is Evan, and I'll see you again next time. Thanks.